A $25 million investment. That is all it took. While American ports drown in congestion and tariff chaos, Canada quietly positioned itself to capture billions in redirected trade. The port of Prince Rupert is now North America's closest gateway to Asia. Ships arrive 3 days faster than Los Angeles, and American businesses are paying attention. This is the story of how Canada outmaneuvered the United States in global trade infrastructure. Not through massive spending, not through political confrontation, through strategic positioning and patience. This analysis examines how Canadian ports are capitalizing on American trade policy disruptions, the infrastructure investments reshaping Pacific shipping routes, why Prince Rupert matters more than most Americans realize, and what this means for the future of North American commerce. The numbers tell a striking story. The Port of Vancouver handled record cargo volumes in the first half of 2025. 85.4 million tons moved through Canada's largest port. That represents a 13% increase over the same period the previous year. And the direction of that growth matters enormously. Trade with Asia grew faster than trade with the United States. China alone accounted for 25.4 million tons of cargo, up 25% from the prior year. Meanwhile, the American share of Vancouver's international trade declined from 19% to 17%. The trend is unmistakable. Canadian ports are pivoting toward Asia, and they are doing it while American ports struggle with congestion, labor disputes, and policy uncertainty. Prince Rupert represents the most dramatic example of this shift. The port sits at the northwestern tip of British Columbia. It is the closest North American port to Asia. Ships traveling from Shanghai to Prince Rupert arrive nearly 3 days faster than ships heading to Los Angeles. For time-sensitive cargo, that advantage is enormous. The port is undergoing a near $1 billion expansion. When complete, export capacity will more than double. The investment includes CanExport, a new export transloading facility on Ridley Island. Initial capacity will reach 400,000 containers annually, and the facility is designed for expansion. The British Columbia government contributed $25 million. The federal government added $49.8 million through the National Trade Corridors Fund. Private investors, including Canadian National Railway and Raymont Logistics, provided the rest. Operations are scheduled to begin in the third quarter of 2026. For that relatively modest public investment, Canada positioned itself to capture trade flows that might otherwise move through American ports. The timing could not be better. American tariff policy has thrown global supply chains into chaos. Chinese goods entering the United States now face tariffs as high as 145%. These costs make American ports less attractive for Asian imports, particularly those destined for Canadian markets or transshipment to the American Midwest. Historically, Prince Rupert shipped more than half of its imported Chinese cargo by rail to American destinations like Chicago, Detroit, St. Louis, and Memphis. This transshipment business is now exposed to American tariffs on Chinese goods. But the port sees opportunity alongside risk. Geopolitical unrest, tariffs, and trade uncertainty have solidified the need for market diversification and alternative access points. The port is reducing dependence on imports and focusing on exports, where Canadian commodities can reach Asian markets without American interference. The contrast with American ports is stark. Los Angeles and Long Beach handle most trans-Pacific container traffic to the United States. These ports have struggled with persistent congestion. Container dwell times stretch to nearly 8 days. Vessel queues form regularly. Labor disputes periodically disrupt operations. The Port of Los Angeles set volume records in mid-2025. Imports rose nearly 8% year over year. But this volume growth came with capacity constraints. Even as vessel handling times improved, dwell times remained elevated. The system operates at its limits. Canadian ports offer an alternative. Vancouver finished ahead of Tacoma in the Container Port Performance Index. Prince Rupert, with its deep natural harbor and ice-free operations, can accommodate the largest vessels in global shipping. Rail connections reach the American Midwest efficiently. The infrastructure contrast reflects different investment priorities. Canadian ports need between $15 and $21.5 billion in upgrades and expansions by 2040. This investment would break bottlenecks, improve efficiency, and modernize aging facilities. However, 61% of currently planned projects remain unfunded. Despite this gap, Canadian authorities are moving forward. Port authorities have at least $10 billion in planned investments over the next 15 years. $5 billion is needed in the next 4 years alone. The federal government has prioritized trade-enabling infrastructure as a strategic necessity. The One Canadian Economy Act passed in July 2025. It aims to stimulate interprovincial trade, reduce costs, and strengthen domestic competition. The government has framed trade diversification as essential to national sovereignty. Prime Minister Mark Carney has set an ambitious goal of doubling non-American exports. These policy choices reflect a strategic vision that American policy currently lacks. The geographic advantages are substantial. Prince Rupert's location offers structural benefits that investment alone cannot replicate. The port sits closer to Asia than any American competitor. Ships save fuel. Transit times fall. For commodity exports like propane, butane, grain, and forest products, these advantages translate directly to profitability. AltaGas and Royal Vopak reached a final investment decision on a $1.35 billion export hub at Prince Rupert. This is the largest private investment in the port's history. The terminal will ship liquid petroleum gases to Asian markets where demand remains strong. The company cited Prince Rupert's structural advantage in delivering products with the shortest shipping time. Alberta, landlocked and dependent on pipeline access to tidewater, sees Prince Rupert as essential infrastructure. The province has funded grain terminals at the port. Now, with American tariffs complicating the traditional north-south trade relationship, pressure is growing for additional export routes through Canadian Pacific ports. The Indigenous partnership model deserves attention. Local Indigenous nations are central to Prince Rupert's development. The primary contract for site development was awarded to an Indigenous joint venture that includes Metlakatla First Nation, Lax Kw'alaams Band, Gitxaala Nation, and IDL Projects, Inc. Metlakatla and Lax Kw'alaams own majority stakes in Gat-Leadon Logistics, the largest container trucking operation at the port. The Metlakatla First Nation is helping build an import logistics hub with federal financing. This represents part of a broader movement toward Indigenous ownership in Canadian trade infrastructure. The approach creates local economic benefits while advancing reconciliation objectives. This partnership model contrasts with contentious infrastructure development in other jurisdictions. It demonstrates that major projects can proceed with community support when benefits are shared appropriately. The rail connections amplify the port advantage. Canadian National Railway operates an extensive network reaching from Prince Rupert to the American Midwest, Eastern Canada, and the Gulf of Mexico. Approximately 20,000 miles of track connect the port to continental markets. This network existed before the current trade disruptions. Now it offers strategic value that planners could not have anticipated. Cargo arriving at Prince Rupert can reach Chicago faster than cargo arriving at Los Angeles, despite the additional ocean transit time. The rail journey is shorter. Congestion is lower. For shippers optimizing total transit time, the Canadian route often wins. The port has invested in rail infrastructure to handle unit trains of over 10,000 feet. 3 loop tracks at Kanksport can accommodate these massive trains efficiently. The integration of port and rail operations creates a seamless supply chain that competitors struggle to match. Vancouver is also expanding. Canada's largest port is not standing still. The Roberts Bank Terminal 2 project would add 70% more container capacity. The Vancouver Fraser Port Authority is searching for a company to build a new wharf. Government at all levels is engaged in discussions about accelerating the project. Peter Zotta, president of the Vancouver Fraser Port Authority, expressed enthusiasm about the policy discussion emerging from Ottawa around the pivot toward Asia. He described the port as a critical piece enabling trade relationships as Canada diversifies away from the United States. The Port of Vancouver handled diverse cargo. Containers represent only part of the business. Bulk commodities, including coal, grain, potash, and sulfur, move through Vancouver terminals. This diversification provides stability that container-focused American ports lack. The trade diversion is already measurable. Statistics Canada data show that Canadian exports to the United States reached multi-year lows in late 2025. The American share fell to 67% of total exports, down from 73% the previous year. This 6 percentage point decline represents the lowest American share since May 2020. The magnitude of this restructuring becomes apparent in absolute terms. Canadian businesses are finding new customers in Asia, Europe, and emerging markets. The infrastructure investments at Prince Rupert and Vancouver position Canada to serve these markets efficiently. This shift is not temporary. The Bank of Canada describes it as structural rather than cyclical. Building new supply chains takes time. Once established, these relationships tend to persist. Canada is making choices that will shape its trade patterns for decades. The American response has been inadequate. American port infrastructure suffers from chronic underinvestment. Congestion at Los Angeles and Long Beach reflects capacity constraints that predate the current tariff disruptions. Labor relations remain contentious. Automation lags behind Asian competitors. Policy uncertainty compounds these challenges. Tariff rates change frequently. Exemptions are granted and withdrawn. Businesses cannot plan effectively when they do not know what rules will apply. This uncertainty drives cargo to more predictable alternatives. The contrast in strategic vision is striking. Canada has identified trade diversification as a national priority. The government is aligning policy, infrastructure investment, and diplomatic engagement toward this goal. The United States has no comparable vision for its port infrastructure. The implications extend beyond shipping. Ports are nodes in larger economic networks. When cargo flows shift, related industries follow. Warehousing, logistics, manufacturing, and distribution all locate near efficient ports. If Canadian ports capture growing shares of Pacific trade, economic activity will follow. Prince Rupert's expansion creates jobs directly. 200 transloading positions, 2,000 additional jobs in warehousing, longshore work, and trucking. These are good jobs in a region that needs economic opportunity. The investment ripples through the local economy. For American port cities, the calculus reverses. Lost cargo means lost jobs. Reduced investment means declining competitiveness. The advantages that American ports once enjoyed are not permanent. They require maintenance through ongoing investment and supportive policy. The consumer implications matter as well. Efficient ports reduce the cost of imported goods. When cargo moves quickly through well-run facilities, savings flow to consumers. When ports congest, costs rise. American consumers ultimately pay for port inefficiency through higher prices. Canadian consumers benefit from the investments their governments are making. Efficient ports mean lower costs for imported goods and better prices for exported commodities. The $25 million investment at Prince Rupert will pay dividends for decades. The strategic implications deserve consideration. Trade infrastructure is national security infrastructure. The capacity to move goods efficiently affects economic resilience. Countries that control efficient supply chains hold advantages in economic competition. Those dependent on others for logistics face vulnerabilities. Canada is reducing its dependence on American infrastructure. If relations deteriorate further, Canadian goods can reach global markets through Canadian ports. This reduces American leverage in trade negotiations. It enhances Canadian economic sovereignty. The United States faces the opposite dynamic. Poor port performance makes American businesses dependent on alternatives, including Canadian ports. This creates leverage for Canada and reduces American negotiating power. The irony of tariff policy producing this outcome should not be lost on observers. The technology dimension adds complexity. Modern ports compete on technology as well as geography. Automation, data integration, and operational optimization determine efficiency. Asian ports lead in these areas. Chinese and Korean facilities handle cargo with speed and precision that few Western ports can match. Canadian ports are investing in technology alongside physical infrastructure. Kang's port at Prince Rupert will feature trucking on private roads that allow electrification and decarbonization. The facility is designed for productivity and sustainability. These investments position the port for future requirements. American ports have moved more slowly on technology adoption. Labor resistance to automation has slowed modernization. Investment decisions are fragmented across multiple jurisdictions. The result is facilities that fall behind global standards. The climate dimension intersects with trade patterns. Shipping contributes significantly to global emissions. Shorter routes mean less fuel burned. Prince Rupert's proximity to Asia offers environmental advantages alongside commercial ones. For shippers and consumers concerned about carbon footprints, the Canadian route is greener. Canada is positioning itself as a leader in sustainable trade infrastructure. Environmental considerations are integrated into port development from the planning stage. This approach attracts businesses with sustainability commitments and positions Canadian ports favorably as regulations tighten. The European Union is implementing carbon border adjustments that will affect shipping routes. Vessels with lower emissions profiles will face lower costs. Ports that facilitate efficient low-emission logistics will gain competitive advantages. Canada is preparing for this future. The lesson is strategic patience. Canada did not outmaneuver the United States through aggression or confrontation. It invested consistently in infrastructure over years. It maintained efficient operations. It positioned itself to benefit when disruptions created opportunities. The $25 million provincial investment at Prince Rupert was one piece of a larger strategy. Federal funding, private investment, Indigenous partnerships, and policy alignment all contributed. The result is infrastructure ready to capture redirected trade flows. This approach offers lessons for other countries facing larger, more powerful neighbors. Strategic investment, operational excellence, and geographic advantages can create leverage that raw economic size cannot overcome. Patience matters. Positioning matters. Execution matters. The future trajectory seems clear. Canadian ports will continue gaining share of Pacific trade. Investment will accelerate as the strategic value becomes more apparent. American ports will face pressure to improve, but structural challenges will persist. The trade relationship between Canada and the United States will evolve. Neither country can fully decouple from the other, but the balance of dependence is shifting. Canada is becoming less reliant on American infrastructure and markets. The United States is becoming more reliant on Canadian resources and routes. A $25 million investment started this story. Billions more will complete it. And when historians assess North American trade in the 21st century, they may conclude that Canada's strategic vision outweighed America's economic mass. The cargo keeps flowing north. The future is being built in Prince Rupert, one container at a time. The broader context of Canadian trade diversification matters. Prime Minister Mark Carney has made trade diversification a centerpiece of national strategy. His government has pursued trade agreements with Indonesia, India, the United Arab Emirates, and potentially the Mercosur bloc of South American nations. Diplomatic missions to China and Qatar signal renewed engagement with markets beyond North America. The goal is ambitious. Carney has called for doubling non-American exports. This would require fundamental restructuring of Canadian trade patterns. The port investments at Prince Rupert and Vancouver are essential infrastructure for achieving this objective. The Bank of Canada acknowledges the challenge. Finding new markets and building new export supply chains will take time and be costly. But the central bank also recognizes that firms with established trade channels and infrastructure to non-American markets have managed to pivot successfully. The provinces are aligning with federal strategy. British Columbia sees itself as the gateway to Asia. Premier David Eby has stated that the province will be the engine of the new Canada that is more independent and less reliant on the United States. His government has invested in port infrastructure, participated in trade missions, and supported diversification efforts. Alberta, despite its political differences with the federal government, shares the interest in Pacific port access. The province funded grain terminals at Prince Rupert decades ago. Now, with American tariffs complicating energy exports, pressure grows for additional routes to Tidewater. The province's transport minister has noted that Albertans are leaving money on the table by not being able to get world prices for commodities. The alignment of provincial and federal interests around trade infrastructure is notable. Political differences on other issues have not prevented cooperation on this strategic priority. The CUSMA review adds urgency. The United States-Mexico-Canada agreement is scheduled for joint review in July 2026. This process could open the agreement to renegotiation. American demands may include provisions that further complicate Canadian trade flows. Canada is approaching this review from a stronger position than it would have been without diversification investments. Alternative markets reduce dependence on American access. Efficient ports provide options if negotiations fail. The leverage dynamics have shifted. The United States Trade Representative will submit results of internal policy review and public consultations to Congress in January 2026. American business groups are participating in consultations about the agreement's future. The outcome remains uncertain. For Canada, the best preparation is reducing vulnerability. Every container that moves through Prince Rupert to Asian markets represents reduced dependence on American goodwill. Every trade agreement with non-American partners expands options. The port investments are not just commercial infrastructure. They are strategic assets. The private sector is responding to the new reality. Canadian businesses are actively diversifying their customer bases. RBC economists note that companies with established trade channels to non-American markets have managed the transition most successfully. Those starting from scratch face longer timelines and higher costs. The port investments help businesses make this transition. Efficient export infrastructure reduces the friction of reaching new markets. Competitive shipping times make Canadian products viable in Asian supply chains. The infrastructure and the business strategy reinforce each other. Foreign investors are also paying attention. The largest private investment in Prince Rupert's history came from AltaGas and Royal Vopak. These companies saw the strategic value of the location and committed $1.35 billion. Such investments signal confidence in Canada's positioning. The Indigenous economic development model creates additional opportunities. Joint ventures and partnership structures distribute benefits while advancing projects. This approach may attract investment that more contentious development processes would deter. The workforce implications are substantial. Port development creates good jobs in communities that need them. Prince Rupert has a population of just 12,000 people. The port expansion will add thousands of jobs in transloading, warehousing, longshore work, trucking, and related services. These are not temporary construction jobs. They are permanent positions tied to ongoing trade flows. The economic base of northern British Columbia is being transformed. Communities that once depended on fishing and forestry now participate in global supply chains. The Indigenous partnership dimension adds another layer of economic benefit. First Nations communities hold ownership stakes in port-related businesses. Employment opportunities flow to community members. Economic development and reconciliation advance together. This model contrasts with port development elsewhere that has generated opposition and conflict. Building community support from the beginning produces better outcomes for everyone involved. The historical perspective illuminates the present. Prince Rupert's founder, Charles Hayes, chose the location over a century ago as the terminus for the Grand Trunk Pacific Railway. He believed its position would seed a trading metropolis. He died on the Titanic in 1912. The railway company defaulted on government loans 7 years later. A government engineer reportedly described the railway as being built 100 years too early. But a century later, Hayes's extravagant vision is winning new appreciation. The location he selected offers advantages that investment alone cannot replicate. History suggests caution about grand predictions. Trade patterns shift, technologies change, political relationships evolve. The ports thriving today may face challenges tomorrow, but geographic advantages tend to persist. Prince Rupert's proximity to Asia will remain regardless of what policies governments adopt. The infrastructure being built now will serve Canada for decades. The investments are bets on the future. So far, those bets appear well placed. The American perspective deserves acknowledgement. American port authorities and logistics companies are aware of the competitive dynamics. They are not passive observers. Investment continues at American ports despite the challenges. Technology adoption proceeds, if more slowly than elsewhere. The question is whether American investment and policy can match the strategic coherence Canada has achieved. Fragmented governance, contentious labor relations, and policy uncertainty complicate American responses. These are not insurmountable obstacles, but they require sustained attention to overcome. American businesses shipping through Canadian ports are making rational choices given current conditions. They seek efficiency and reliability. If American ports improve, cargo will return. The competition is ongoing. But Canada has seized the initiative. The investments are being made. The relationships are being built. The infrastructure is taking shape. Reversing these trends will require American action, not just Canadian stumbles. The conclusion emerges from the evidence. Canada outplayed the United States on port infrastructure. It did so through strategic investment, geographic advantage, operational efficiency, and policy coherence. A $25 million provincial contribution catalyzed billions in total investment at Prince Rupert. Similar dynamics are unfolding at Vancouver. The implications extend beyond shipping. Economic activity follows efficient infrastructure. Jobs locate near competitive ports. Communities benefit when they position themselves at the center of trade flows. For observers of North American commerce, the lesson is clear. Strategic vision and consistent execution matter more than scale. Canada, with 1/10 the American population, has built port infrastructure that competes globally. The United States, with vastly greater resources, has allowed its ports to fall behind. The cargo keeps flowing, the containers keep moving, and increasingly they are moving through Canadian ports to Asian markets. A $25 million investment started this transformation. Where it ends depends on choices yet to be made. But for now, Canada has outplayed America, and it only cost $25 million to begin.